This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street, produced Thursday, May 22nd, 2014, and maybe Friday, May 23rd, 2014. I'm going to talk to you today a little bit about what's going on behind the headlines. Nobody's covering it, nobody's paying any attention to it, but I think it may be the most important story of the year, at least the way it has developed so far, and the way it will continue to develop for at least the next week or two. I've mentioned the idea that the Fed carefully calibrates QE to total Treasuries supply. And as I like to do, I thought I'd try to illustrate it on a chart and plotted it from zero beginning in 2009. So this is the change in the size of the Fed's balance sheet versus the amount of Treasury debt outstanding. So that each month you see the amount of new Treasury debt versus the amount of additional QE that's pumped into the market. From the beginning of the year, this year to here, is the amount of new QE on the blue line. And here's the amount of new Treasury supply up here. Now back in 2009, when the Fed was starting QE1, coming off the bottom of the market in March of 2009, you can see they calibrated the amount of QE to the immense increase in Treasury supply that was occurring as a result of the recession. Then they began to cut back a little bit, and they went into a pause, I believe around April 2010. And as soon as they did that, stocks came down because Treasury supply was still increasing. That put pressure on the market that the Fed was not supporting. They got cold feet towards the end of 2011, and they instituted QE2 in here. So from the fourth quarter of 2010, if I said 2011 before, 2010, until the middle of 2011, the Fed was in QE2, and it was almost keeping pace with the growth in Treasury supply. And when we had, in this area in here, we had the debt ceiling impasse. So supply was really growing, but they moved it off the books for a while, and then they caught up here. So there would be a straight line connecting these 2 points. Then in 2011, the Fed paused QE. If you recall, that's when they instituted the twist, where they were selling shorter duration treasuries from their holdings and buying longer duration. At the same time, they also began the MBS replacement program, because with interest rates as low as they were, people were paying off their mortgages and refinancing, and those refinances resulted in these mortgage-backed securities being paid off that the Fed was holding. So rather than allowing its balance sheet to shrink, the Fed decided that it would buy more securities, more MBS securities from the primary dealers. So even though it kept its balance sheet flat in here, between the middle of 2011 and the latter part of 2012, the Fed actually pumped about $300 billion into the accounts of the primary dealers. So those of you that subscribe to the professional edition Fed reports have seen the chart where I show the actual cash to primary dealers. I couldn't reproduce that on this chart, but this line here actually represents the amount of cash that the Fed was still pumping into the primary dealers, enabling them to continue to finance this ongoing increase in Treasury supply. So stock prices were able to creep up during that period. At the same time, they were getting some help from the Bank of Japan. I've shown you that chart also in the past. So from this point, this is where the total cash pumped into primary dealer accounts would have been. So in late 2012, the Fed began QE3 with the purchase of Treasury securities and MBS, and then they added more to that with QE4 here in January of 2013. So at the end of 2012, they started QE3 and they added QE4 just past that in January. And that would look something like this in terms of the cash going into the primary dealer accounts. So again, it's pretty close to the curve in treasuries. Now here we had another debt ceiling impasse where they pretended not to borrow any more money, but they were just shifting accounts around, so they really were doing this. They just kind of kept it off the books for a while. So the increase in purchases from the primary dealers by the Fed from the end of 2012 until the end of 2013 was on the order of about 1.1 trillion they added during this period. And Treasury supply increased almost $1 trillion. So the Fed pumped approximately $1 trillion and the Treasury borrowed approximately $1 trillion over this 13-month period from November of 2012. So that's what I mean when I say the Fed carefully calibrated the amount of QE to total Treasury supply. And in so doing, they create more than enough excess cash because obviously there's always other buyers for treasuries as well. Foreign central banks are buying them from time to time. Our domestic banks are buying them from time to time. Other investment funds are buying them from time to time. So the Fed does not need to absorb 100% of treasury supply. It needs to take a certain percentage of it to keep things on an even keel, but it doesn't need to absorb all of it. So when it in effect prints an amount of money that's enough to absorb 100% of treasury supply, that creates an ocean of excess cash that goes into speculation. The primary dealers speculate with it. They lend it to their hedge fund clients. They speculate with it. And what happens is you get a bubble in stock prices here. Now, interestingly, the Fed began to taper here in 2014. So the curve begins to flatten out just a little bit, okay? But the Treasury supply curve was also flattening out. The deficit was actually coming down. Withholding taxes were going gangbusters. I'm going to show you that chart in a minute. And the Treasury was able to pay off a little bit of debt in April and May, actually, so far. But the stocks have not responded the way I expected them to. They've been a little stronger since January, but I expected a big rally in here. We haven't gotten it. I think that cash is still out there. The problem and the real issue, and it's an issue I don't think anyone is addressing, I haven't seen it anywhere, and I think it's maybe the most important issue that the market is facing, is that the amount of federal revenues has begun to fall very short of forecast over the past 3 or 4 weeks. So let's go take a look at some of that data and the potential danger that it represents. This chart shows the real annual percentage change in withholding taxes collected every day by the U.S. Treasury and reported the following day. So this chart is real time right up through yesterday, Wednesday, May 21st. It shows the year-to-year change adjusted for CPI, about 2% a year. And as you can see, in the period from the middle of February until the end of March, this line was running at a 5 to 6% annual rate of gain. That is a very strong reading, obviously indicating a very strong economy. But then something happened at the end of March, and as you can see, the growth rate began to radically decline until it fell to under 2% a week ago. Now, it has bounced back slightly here, but it's way too soon to call that an upturn. And by the same token, a 6 or 7 or 8 week decline may just be a normal cyclical breather in the economy. So we've got to watch this over the next couple of weeks. However, this has already created an identifiable problem. I began to warn back in here that if this continued, Treasury supply would start to increase. And in fact, that has happened. So let's take a look at that data. Every 3 months, the Treasury Borrowing Advisory Committee, known as the TBAC, which is basically a coffee clutch of a couple of primary dealers, top people, they get together and they give the Treasury a quarterly report on expected supply, forecast supply during this quarter. So the updated amounts for the second quarter were just issued on April 30th. And as you can see, these amounts were forecast last week for the current week. 4-week bill of $29 billion, 3-month bill of $24 billion, 6-month bill of $22 billion. The same next week and about the same last week. But because of the shortfall in withholding taxes, the 4-week bill, instead of being $29 billion, has been $40 billion for the 2 weeks at the beginning of the month. And this week, when it was forecast again to be $29 billion, it came in at $45 billion. That's $15 billion above forecast. The TBAC also forecasts any expected need for cash management bills. Didn't forecast any cash management bills for the June period. And just today, the Treasury announced that it's going to auction on June 3rd $25 billion in cash management bills. In other words, it expects to run out of cash and need that much cash before the June 15th quarterly estimated tax collections come in from corporations and individual taxpayers. So there's another shortfall. Next week, we have this absolutely monstrous calendar. Between the 27th and June the 3rd, there are going to be 10 separate offerings of bills, notes, and bonds. This is the busiest calendar since the days of the TARP offerings, the money to fund the TARP back during the market collapse of September 2008, when stock prices were crashing. So this is a big deal. Now, it may not mean much if the size of the auctions aren't that big, and they're certainly not going to be as big as they were in the September 2008 when the Treasury was raising a couple $100 billion every week. But take a look at this. This is the actual amount that's being offered on this line, and this is the TBAC estimate on the second line. So the 13-week bill is going to be $1 billion more than estimated. Same for the 26-week bill. And if the 4-week bill is again $45 billion, then it's going to be $16 billion more than estimated. And these estimates were just done a couple of weeks ago. They were posted on April 30th, and they were given to the Treasury just a few days before that. So these are only a couple of weeks old, and already we're seeing huge misses in terms of the forecast versus the actual revenue collections by the U.S. government. The notes and bonds are going to be about the same, no changes there. The 2-year floating rate note that's going to be auctioned on the 28th is $2 billion larger than expected. And then you have this 14-day cash management bill that simply was not in the forecast. As a result, we are going to see, assuming we get a $45 billion 4-week bill again next week, we're going to see the total Treasury supply offered between the 29th and, between the 27th and June 3rd, $45 billion above forecast. That's like 20% more than they forecast. So there's a serious problem developing here. On this line, you see the total new cash that's going to be raised, or the amount of new supply. So between the settlement dates of Thursday the 29th, Friday the 30th, and then Monday, June 2nd, and then June 5th again on Thursday, we're looking at $99 billion in new supply. That's the biggest hit that the market has had to absorb in a very long time. I don't know exactly when, but I can't remember $99 billion over the course of a week in the last more than a year. At the same time, this comes at the time of the month, that time of the month when the Fed is not injecting that much cash into the market. It's only doing, a billion or less than a billion per day in treasury purchases. So if there's going to be a problem, I think we're going to see it at the very end of this month. Sometimes these things are delayed. People may be coming back from their little holiday and feeling good about things, and especially if the S&P gets through resistance at 1895 and then 1905. We have cycle targets of 1925, 1930 in that area. We've had them for a while. And there could be a little bit of froth that builds up. But by sometime around May 31st through the first week in June, I think we're going to see a little bit of a crunch. And that could be enough to turn the tide. We'll just have to keep an eye on this growth of Treasury supply and whether or not the shortfall in revenues continues. If this is the beginning of a trend and a weakening in the U.S. economy at the same time as the Fed continues to taper, then I think we're going to see a changed environment later on this summer. So that is what I see as the most important story impacting the market. We'll find out if I'm right in the days, weeks, and months ahead. Either withholding taxes will return to a stronger growth pattern and the federal government's revenues will increase so that the deficit begins to shrink again and there is less treasury supply, which would be a bullish factor, or this weakening trend will persist, the economy will slow, and federal revenues will continue to fall short of projections, resulting in greater treasury supply and more pressure on the market. The secondary story, or perhaps equally important, more important, would be how the Fed responds to this, and we simply cannot predict that. At least I can't. So I'm going to follow the story very closely in the weeks ahead in the Wall Street Examiner Professional Edition and from time to time here on Radio Free Wall Street. Until we get together again later next week, enjoy your holiday weekend, trade sane, and I'll see you next week. This has been Radio Free Wall Street with Lee Adler. Find this program on the web at radiofreewallstreet.fm or wallstreetexaminer.com.